After 2 years of surprisingly strong growth driven by massive state spending, Russia's economic momentum looks like it's suddenly slowed. Growth has stalled, energy revenues have plunged, and the budget deficit is ballooning. This is all a sharp reversal from the early years of the war, when defence outlays and subsidies kept factories humming and annual GDP growth above 4%. So in this video, we're going to take yet another look at the Russian economy, why the latest data doesn't bode well for Putin and co, and what the Kremlin might do to reverse this trend. Could you rank every single politician in the world? Hear our thoughts and argue with us on our podcast, The World Leader Leaderboard. Find it over on the TLDR Podcast YouTube channel or in your favourite podcast app. So let's start with a quick recap. For much of the war, Russia's economy seemed remarkably resilient, defying early predictions of collapse. Extravagant military spending, which grew 25% year on year to about 13.2 trillion rubles last year, accounting for about a third of the federal budget, helped keep the economy going in the immediate aftermath of the war, with GDP growth coming in above 4% in 2023 and 2024, following a contraction in 2022, cushioning the blow from Western sanctions. But the picture has since soured. After 2 consecutive years of 4.3% growth, the latest data suggests Russia's economy is flirting with recession, having contracted by 0.6% in the first quarter of 2025. While the economy has returned to growth in the second quarter, it was pretty meagre, and the finance ministry has since dramatically downgraded its forecasts, projecting growth below 1% for 2024-25, down from earlier forecasts of 2.3 to 2.5%. Now, the way we see it, there are 2 key reasons why this growth has stalled. The first, and probably the most important one, is high interest rates imposed by the Russian central bank. For context, inflation has been running hot in Russia for the past 2 years, with year-on-year inflation rising from a low of 2.3% in April 2023 to over 7% throughout 2024, and then a new high of 10.3% in March 2025. To bring inflation down, the Russian central bank hiked interest rates from 7.5% in 2023 to a high of 21% in late 2024, making it more attractive to save rather than spend rubles, reducing aggregate demand and, therefore, inflation. While these super steep rate hikes succeeded in bringing down inflation, which has now fallen for 5 consecutive months to a recent low of 8.1% this August, they also dampened growth. The Russian central bank tried to offset this slowdown and avoid a full-blown recession by cutting rates earlier this year, even though inflation was still running above 8%, more than double the central bank's target of 4%. While these cuts might have helped Russia avoid a technical recession earlier this year, rates are still very high, which means they'll continue to act as a drag on growth, and premature rate cuts risk restarting Russia's inflationary crisis, especially if Ukraine's strikes on Russian refineries continues to push up gasoline prices. For context, Ukraine's strikes have disrupted between 15 and 25% of Russia's overall refining capacity, triggering a dramatic decline in domestic diesel and gasoline production. Russia has recently banned diesel and gasoline exports to increase domestic supply, but this hasn't really worked. Wholesale gasoline prices have risen by about 40% in recent months, and are now at record highs, according to data from the St. Petersburg Exchange. Anyway, the second reason that growth has stalled, however, is Russia's energy sector, which is in many ways the backbone of its economy. For context, oil and gas exports account for roughly 40% of the country's GDP, but this year revenue has fallen sharply. Oil and gas revenues are down about 21% compared to last year, and according to the 2025 budget, the Kremlin is expected to collect around 22% less in tax income from the sector than it did the year before, the lowest since the pandemic. Oil-adjacent revenues have also suffered. Revenues from the mineral extraction tax on oil are down 32%. Gas tax revenues have plunged 52%, and export duties have fallen by nearly 30%. This is in part due to strikes on Russia's refineries, but there are also at least 2 other factors that have contributed to falling revenues. First, the ruble, which is up about 20% against the dollar this year, thus making Russia's energy exports less competitive on the international market. Second, OPEC Plus's production hikes. For context, OPEC+, the international cartel of oil-producing states led by Saudi Arabia and Russia, has consistently increased production over the past year or so, despite the fact that oil prices are currently quite low and the global economy is slowing down, which usually means less demand for oil. This is largely because producers like Saudi Arabia are trying to bankrupt American shale producers, who can only turn a profit when prices are high, but low prices are bad news for the Kremlin, not least because Russia sells its oil at a discount. For context, the Russian central bank now estimates the average price for a barrel of Russian oil in 2025 and 2026 will be $55, down from $68 in 2024. This has put a direct strain on the Kremlin's budget. In the first half of 2025, Russia already hit its full-year borrowing target, around 1.7% of GDP, and the Russian Finance Ministry now expects the budget deficit to reach around 2.6% of GDP by the end of the year, despite a slight decrease in military spending. This might not sound that large by international standards. After all, most European countries are due to run deficits significantly larger than this in 2025, and the US is on track for a deficit roughly twice as large. Nonetheless, it's worth mentioning that the Kremlin doesn't have access to international capital markets, which means that it needs to borrow from Russian savers. This means that even relatively small deficits can be surprisingly hard to finance, and often require Russia to offer higher interest rates, which in turn risks stoking inflation, because offering high interest rates to domestic lenders implies pumping lots of rubles into the economy every time the Kremlin has to make an interest payment. Anyway, to plug the gap, the Kremlin has tapped the National Wealth Fund, its rainy day reserve, made up of a mix of foreign currencies and liquid assets like gold. But this buffer is shrinking fast. According to Bloomberg, 2/3 of the fund has been spent since the war began, and its liquid assets have fallen below 3 trillion rubles, the lowest level since 2019. With reserves running thin, the Kremlin has decided to raise taxes for the second consecutive year, despite Putin's earlier pledge not to do so before 2030. Since the start of 2025, the progressive personal income tax has increased from 13% to 15%, and from 2026, VAT will rise from 20% to 22%, while taxes on small businesses will also increase. Normally, these sorts of tax fiddles wouldn't be problematic, but they're somewhat risky in the current context. They risk tipping the Russian economy into recession, and the VAT rise risks stoking inflation when it's already way above target. You know as well as us that in this current climate, it's important to stay sharp, and perhaps even more important to be precise. Well, our sponsor this week, Henson Shaving, knows this better than anyone and take pride in their precision. That's because their razor perfectly holds the blade at a 30-degree angle and extends it only 0.0013 inches, less than the width of a human hair, which means incredibly tight tolerances, very high standards, and superb precision. This also results in a much healthier shave compared to the overpriced plastic razor cartridges that leave your skin feeling sore and mistreated. Speaking of plastic, you probably don't realise, but over 2 billion plastic razors are thrown into landfill each year in the US alone. So not only are they wildly expensive, but they're also terrible for the environment. The same can't be said for Henson, as their razors are completely plastic-free. From the blade to the box, everything Henson ships out to you is entirely recyclable. Henson strives to protect your skin in a way that's accessible, affordable, and kind to the environment. And while it might sound intimidating changing the blade yourself, it's actually remarkably easy to do so, and even kind of satisfying taking full control of your shave. If you've been meaning to try out Henson, there's no better time to start than right now, as we're offering you 100 free blades with your purchase when you use code TLDR at checkout. Just go to hensonshaving.com/TLDR or click the link in the description and you'll be on your way to a healthier shave.